Do adjusting entries confuse you? Well, in this screencast I'm going to explain what adjusting entries are, why we need them, and how to do them. Adjusting entries are entries made to record revenues and expenses that have been earned or incurred but have not been recorded yet. This may be for two reasons. The revenue or expense is deferred, meaning cash is received before the revenue is earned, such as a magazine subscription, or cash is paid before the expense is incurred, such as rental payments. The second reason is that the revenue or expense is accrued, meaning cash is received after revenue is earned, such as pizza delivery, or cash is paid after expenses are incurred, such as paying salaries. So how do we record adjusting entries? Let's take a look at some examples. Using both an unadjusted trial balance and additional information, we are able to identify which accounts need to be adjusted. Suppose that on the 31st of May, Diamond Cleaners have provided a year's worth of cleaning services that were prepaid by the client. This is an example of a deferred revenue, as the business has already provided the service, meaning it no longer has a liability to the customer, but has earned revenue instead. However, as you can see, the unearned revenue account still shows $2,000 in liability, so we have to perform an adjusting entry. To adjust liabilities down and revenue up, you conduct the following entry, debiting unearned revenue and crediting service revenue. This entry would then be posted to the relevant T accounts as shown. Now let's look at a deferred expense. Suppose that on the 31st of May, after a fiscal count, Diamond Cleaners determined that it had $650 of supplies remaining. From this information, we can see that the business must have used $350 worth of supplies. However, the trial balance still shows $1,000 worth of supplies. Therefore, we debit supplies expense and credit supplies in order to adjust supplies down. This entry would then be posted to the relevant T accounts as shown. To demonstrate accrued revenue, suppose that on the 31st of May, Diamond Cleaners provided 5 days worth of a week-long cleaning service, where the customer had agreed to pay $300 per day. Since the business had only provided 5 days worth of service, they had earned $1,500 worth of revenue out of the $2,100 week. However, the trial balance does not reflect this because Diamond Cleaners had not issued a bill. Therefore, you should debit accounts receivable and credit service revenue to adjust receivables and revenue up. This entry would be posted to the relevant T accounts as shown, remembering the entry made to the service revenue account in the previous example. The final example is an accrued expense. Suppose the interest rate for Diamond Cleaners note payable is 6%. From this, we can determine that the business has incurred 1 month of interest, which totals at $45. However, this expense and the related obligation are not reflected in the trial balance because they have not yet been recorded. The entry shown whereby interest expense is debited and interest payable is credited is needed to record this adjustment. This entry would then be posted to the relevant T accounts as shown. Finally, the amounts found in the adjusted T accounts can be used to develop an adjusted trial balance. This adjusted trial balance can then be used to create the income statement, the statement of retained earnings, and the balance sheet.
Created using Powtoon.